You had a little Whitney Houston in there. Yeah, I love that. We got Larry in the pits of the CME, Larry Shover. You're on a first-name basis with us, Larry.
Thank you.
Hello, Larry. The pits of the CME, he's right there. Tad Hill is a guy who was warning sell in May and go away, and that'll arrive earlier this year. He's got ways for you to play a pullback. And Bill Stone, whose last pick up about 8% since he was on the show, he's back with more ways for you to make money. But first, let's start with hello, Larry, in the pits of the CME. Another very solid day for the bulls. And yeah, okay, to give me the sob story about volume, but what jumped out at you here?
What jumped out, a profound change in sentiment that we've seen. We haven't seen this in a very long time, where the first quarter was marked by people rushing to safety. This is the first time in a very long time people rushing out of safety into cyclicals. And I think traders behind me are wondering, is this the start of something new, or is the trade more crowded and people are just getting scared and reallocating? No one seems to know, but there is a profound shift of sentiment that we've seen today.
It's interesting, Larry. I mean, is there any way we can even come up with a ceiling on this move right now? I mean, stocks are the only place to be. You don't want to be in cash, and the only place you can get any decent return is in equities, right?
Well, maybe yes, maybe no. I'm on the fringe. I mean, I feel like there's nothing wrong with being in cash. And as I said 6.5 weeks ago, I would step aside here, not allocate as heavily as I'm normally allocating, waiting for something else to tell me that I should be fully allocated to the stock market. I do believe everything we're seeing is fully expressed right now. We need another metric to carry us to the next leg. So it's dangerous territory. I would lower my allocations and be in cash.
Okay, just for a little bit, right? Because, we're looking at people who are saying maybe in the next 2 months. But I've heard that the past 8 months that we would see a correction. Hasn't really happened. I mean, for a second, the Cyprus thing frightened people, but not in a really meaningful way.
Exactly. No, I don't want to frighten anybody. I mean, I think it never makes sense to wait for the coast is clear. We need to be allocated to the stock market. However, what I'm saying is I would lower my key allocation right now and hold it in cash, waiting for something else to carry the day, whether it be the Chinese numbers that continue to get better, whether our earnings season becomes a lot more profound, better than what we expect it to be. Something has to carry the flag, because right now there's a lot of red flags in my portfolio, and I'm just tempering it down just a little bit.
Okay.
Let's bring in the rest of the panel. Bill Stone, let me ask you, you are bearish in the short term, aren't you? You could say, to Liz's point, it's been America's favorite spectator sport. When are we going to get this, pullback, much talked about? It hasn't happened yet. When does it happen and by how much?
Yeah, and I would say I'm not really bearish in the short term. I think we've, for a long time, said, hey, you really do have to concentrate on the long term when you're making a decision. I just want to prepare people that, hey, we've been probably more than double the amount of normal trading days since we had a 5% correction. It's going to come. Frankly, I'll tell you, I don't know when it comes. I think you just prepare yourself and get yourself in good position, maybe have some cash so that you're ready to buy during it. But I actually wouldn't necessarily pull back a whole lot at this point.
Okay, so we've got two who say at least get some cash, at least in a form of dry powder there, Tad. Are you of the same belief?
Well, I think the monetary policy is clear and it's going to stay the same. There's not just a war in Afghanistan. We've got a war here in the United States on seniors and savers, 10-year Treasury paying 1.75. So where do you go? So we are in a secular bull market. I think that's very clear. But I do expect that earnings in Q1 are going to be a little softer than they have been in previous quarters, and we are going to see the sell in May probably 30 days early. So we're keeping some dry powder because we think there will be opportunities, and we're positioning ourselves to take advantage of them.
Bill, would you agree with that? Because let's face it, the guidance from the fourth quarter was so weak that they can't do anything but surprise to the upside, right?
Yeah, I think first quarter is going to surprise on the upside, but he's right in the sense that certainly the momentum in earnings has slowed down quite a bit. We expect it to pick up towards the second half of the year, but I do think you're going to be able to beat out those already lowered expectations. So that is the way it's difficult to say that it's necessarily going to be a disappointing earnings season.
Okay, so let's get to your names, Bill. You like Nike, Becton Dickinson among some of your plays. What do you like about, it's sexier to ask about Nike, but I'm interested in Becton Dickinson. They make just about every syringe that a lot of doctors need to use. This is a healthcare play in an obvious way, but where do you see it really going?
Well, the interesting thing about them is they have about a quarter of their sales in the emerging markets. There's the real opportunity, you know, in terms of margins. You know, you mentioned it in terms of the injectables, and over roughly half of the revenues are from disposables. So they've been extremely consistent in terms of revenue, and really it's a matter of some new innovation they've got going on.
Nice
in terms
one-year chart too, by the way, really nice.
And the beauty is they've 41 straight years of dividend increases. So they have been thinking about return of capital to shareholders.
All right, Ted, what do you say? I know you're not a particular fan of consumer discretionaries, are you? What do you like?
No, not right now. You know, I think with the increase of the taxes that have hit people's paychecks, we're starting to see that take effect in the retail sector. We like energy. You know, natural gas is not a new theme, but we believe it's a game changer. And a lot of our clients, guys, they are seniors. They're people that are retired. And where are you going to go find some yield? Yeah. So in the energy sector, I really like master limited partnerships, MLPs. Energy Transfer Partners is one of those. They're paying a 7.25% dividend. They just issued a new share offering last week. We took advantage of that because the price dropped, so we're going to see some price appreciation there at the same time that we're getting a dividend. And for our clients, they need income, so we've got to find it where we can. And a 10-year Treasury, like I said earlier, that's certainly not the place for it.
Can I just push you, Tad, for a second? You just said you didn't think consumer discretionary was a place to be, and yet you like Apple. Is that discretionary?
Well, there's a difference there because Apple is squarely in the increase of the middle class around the globe. So people using PDAs, smartphones, that trend isn't going away. You know, in the past, the last thing you were going to not pay was your mortgage payment. But these days, people are walking away from their mortgages in droves. But the last thing they're not going to pay is their cell phone bill. So I think that with Apple, now the other thing with Apple, and the gentleman talked about it earlier, you've seen a lot of fundamental shifts here. I mean, their stock's down 300 points. It was priced to perfection in the past, but I think right now it's underpriced. So in general, I'm not bullish on consumer discretionary, but when you talk about specific technologies like the smartphone, Apple's square in the sights of being able to gain from that.
What do you think, Bill, on Apple? You know, to be honest, let's face it, Apple and Facebook have been pretty much of a buzzkill for investors who may have been thought about jumping in the market. They haven't done well. They've dragged down the NASDAQ. What do you think about Apple and the pricing right now?
You know, we still own some Apple. I guess I would say we're generally speaking underweight technology a bit, so we're not ready. We've loved technology for years, just a little bit underweight at the moment relative to some other more cyclical areas.
Thank you so much, all of you, Tad Hill and Bill Stone, and hello, Larry. We'll check in with you in a few minutes to see how the S&P futures close. Larry Shover, thanks, guys. Right now, we're about 58 seconds away from the S&P futures pits closing. Larry Shover, right there. How does it look?
Well, right now, it's all about growth. It's all about earnings. And traders behind me are waiting for further information before taking a next shot on which way the market's going to go. Let's face it, we did have a correction without a crash over the last 3 or 4 weeks as everybody piled into safety, out of financials, out of materials. Traders are on hold, waiting to see what's going to happen next. And that's what's going on behind me right now as we see.
And there is the bell for the S&P futures. Larry, thank you very much. Amazing.